Death and taxes. Two things nobody escapes. One group of people escapes the second one, legally. So why them, and not you? If you make 60 grand a year, after the standard deduction, the IRS taxes the top of that at 12%. All in, you hand over about 5 grand. And then there is a company that makes $1 million in profit and pays 50 bucks. That's 0.005%. You paid more than that on lunch. So why them, and not you? In this video, I'll show you how that's possible, what a tax haven really is, how a single dollar of profit leaves a high-tax country and lands somewhere it's barely touched, the biggest companies on earth doing it in plain sight, and whether any of it works for someone like you. Then at the very end, I will show you a move that ties it all together, a move rich people use to turn pay the tax later into never pay it at all. It all starts with two words you think you understand: offshore banking. You've heard it before, and you already decided what it means. Some criminal in a ski mask moving cash-filled briefcases through a secret account. Secret account funding shady people in a movie. Hollywood sells that version hard. Governments kind of love it too. A scared public is a compliant one. But the real thing is boring. It's legal. Companies and wealthy people use it every single day. So what is it? Offshore banking just means keeping your money somewhere the rules treat you better than home does. These places have a name: offshore financial centers, and some of them built entire economies around one job: attracting the wealthy. Let's do it by offering 3 things: little to no tax, real privacy, so your name doesn't sit on a public record, and loose reporting, so you don't explain every dollar the way you would back home. That's the what. Most people roughly know this part. And if it's this legal and this ordinary, then there's clearly a line somewhere. Step over it, and smart planning turns into a prison sentence. So let's find that line. It comes down to 2 words that sound almost the same. They're not. Avoidance and evasion. Tax evasion is illegal. It's hiding money you owe tax on. Getting paid in cash and never reporting it. That's a crime, full stop. Tax avoidance is legal. It's using the rules to owe less. Writing off a real business lunch, taking a deduction you're allowed to take. Same goal, 2 different worlds. And the line between them? Honestly, a lot of it comes down to paperwork. Hold on to that. Everything I show you from here lives on the legal side of that line. Do it wrong, skip a form, hide a number, and you've stepped over it. So that's the line. Now here's how the money actually moves around it, and it starts somewhere strange. The core trick has a fancy name: jurisdictional arbitrage. Forget the name. It just means different countries have different tax rules, and you can legally arrange things so the friendlier country's rules apply to you. Take the Cayman Islands. No income tax, no capital gains tax, no corporate tax. The British Virgin Islands work the same way. 0. So here's how a company uses that. Let me trace $1 of profit through it. A company sells a product, but the right to sell that product, the brand, the patent, the software behind it, isn't the product. It's an idea. And that idea gets owned by a small company parked in a no-tax country. Now, the main company pays that little company a fee. Rent, basically, for using its own idea. Back home, that fee counts as a business expense, so it shrinks the tax bill. In the tax haven, that same fee lands as income, and barely gets taxed because of low to no taxes there. The product never moved. The ownership of the idea did. That's the engine. It's called profit shifting. Then there's a second layer, and this is the part that stings. The wealthiest people often don't even own the company. A shell company, one that exists only on paper, no office, no staff, owns the assets. And who owns the shell company? A trust. A trust is basically a legal box that holds things for you. You're the one who benefits, so you get to use what's inside without technically owning any of it. The house, the yacht, the portfolio. On paper, the rich own almost nothing. Their boxes do. Though, I'll be fair, it's getting harder than it used to be. Governments are building registries now, trying to see who's really behind these things. That's the theory. But does anyone actually run this at scale? They do. This isn't some underground thing. None of this is hidden. It's written into their own public filings. Companies like Apple and Google built it right into the paperwork. And the scale is hard to picture. Economists at Berkeley and Copenhagen estimate that close to 40% of all multinational profits get shifted into tax havens. That's around $600 billion a year. Take Google. Their setup even had a name, the Double Irish with a Dutch sandwich. Two Irish companies with a Dutch one in the middle, the sandwich. Here's the move. A company can be incorporated in one place but taxed in another. Born in Ireland on paper but taxed in Bermuda. The trick is making those two places different. In 2017, Google moved nearly 20 billion euros, about $22.7 billion, through a Dutch shell company to Bermuda. That Dutch company paid 3.4 million euros in tax that year on a profit of 13.6 million, while billions flowed straight through it. And the final stop in Bermuda? Google's only address on the island was a post office box, number 666. All of it legal. And then it ended. Google scrapped the structure after 2019 once the US changed its tax law and Ireland closed the loophole. Now Apple? This is where it gets dramatic. There's a number called the effective tax rate. It's not the headline rate, it's what you actually paid after everything. Apple's effective rate on certain European profits got as low as 0.005%. That's about $50 of tax for every $1 million of profit. And then the story turned. In 2020, a lower European court actually ruled in Apple's favor. They won. Case closed, or so it looked. Then, in September 2024, Europe's top court reversed it and ordered Ireland to recover 14.3 billion euros from Apple. Won, then lost, on the final appeal. Now, hold those two numbers next to each other. You, on 60 grand, hand over about $5,000. Apple, on billions in profit, paid 0.005%. That gap is the whole video in one picture. So the biggest companies on Earth do this out in the open, in documents anyone can read, which raises the obvious question: why hasn't anyone stopped it? The world actually built a fix. It's called the Global Minimum Tax, or Pillar 2. The idea is simple. Big companies must pay at least 15% no matter where they park their profits, built to end the race to the bottom. And it almost worked. Over 50 countries switched it on, including every EU member, but the US Congress never did. And one of Trump's first moves back in office was an order declaring the deal had no force or effect here. So they cut a side deal instead. On January 5, 2026, 147 countries agreed to a side-by-side system, one that exempts US companies from the very rules everyone else follows. The official reason? Sovereignty. The Treasury Secretary said the deal recognizes the tax sovereignty of the United States. Read that again. The country home to the companies running these structures wrote itself an exemption and called it sovereignty. So the fix exists. The biggest player just stepped around it. Which leaves the only question that matters to you, the one watching this. Could any of it ever work for a normal person? Short answer for most people, no. And it comes down to one brutal rule. The US taxes you based on citizenship, not where you live. It's one of the only countries on Earth that does this. Move to Dubai, keep your passport, and you're still on the hook to the IRS. That single rule kills almost every just move abroad plan you've seen on the internet. There is one real exception for US citizens: Puerto Rico. It's American soil, but it runs its own tax code, so you don't have to give up your citizenship to use it. Under Act 60, qualifying residents pay 0% on Puerto Rico-sourced capital gains, dividends, and interest. Capital gains, by the way, just means the profit when you sell something for more than you paid. But the door is closing, and it's guarded. Anyone applying from January 2027 onward now faces a 4% tax on that income. The 0% era is ending. You have to be a real resident, 183 days a year, an actual home, not just paperwork. And the IRS is actively auditing people who claim it without truly living there. The fantasy, meet the enforcement. So what about actually leaving for good? Places like the UAE have zero personal income tax, but to escape the IRS, you have to renounce your citizenship. That's permanent. Then there's the small legal version anyone can do. You can open an account in another country. Just know one thing: if your foreign accounts add up to more than $10,000, you have to report them to the US government. Skip that form, and remember Act 2, you've crossed the line. So, the honest reality? Unless you're earning into the mid-six figures, the cost and the headache aren't worth it. For almost everyone, The offshore version is a dead end. But here's the flip. You're already doing a version of this. You just call it something else. It's called a Roth IRA, a 401k, an HSA. These are accounts the government lets you grow money inside, either completely tax-free or with the tax pushed way down the road. Same idea as the Cayman Islands. Legally shield money from tax, just domestic and sized for a normal life. The rich have an offshore trust. You have a Roth. Same move, different number of zeros. But a 401k only delays the tax until the day you pull the money out. The rich found a way around that part too, a way to never pull it out at all. And that's the answer to the question we started with. Remember the question from the start? How do you spend money you never paid tax on? Here's the answer. You don't sell anything. You borrow against it. Say you own a pile of stock. You go to a bank and use it as collateral for a loan. The bank hands you cash, and a loan isn't income, so there's no tax on it. You got your money, you paid nothing, you just owe the loan back. In 2013, Apple did exactly this. It sold $17 billion in bonds instead of touching its overseas cash, the biggest corporate loan anyone had taken at the time. Why borrow when you're sitting on billions? Because bringing that cash home meant a tax bill. Moody's estimated borrowing saved Apple as much as $9.2 billion in taxes. So that's buy and borrow. The last step is the one that finishes the whole thing. You hold it until you die. You only owe tax on an investment when you sell it, when you realize the gain. Never sell, and you never realize it, and you never owe. And when you pass it on, at death, the tax clock resets for your heirs. The entire gain that built up across your whole life gets wiped clean. They inherit it at today's value, and the lifetime of profit is never taxed as a capital gain. The rich never really lived on a paycheck. They lived on assets, and you can start building the same thing without a single offshore account. I broke down 5 assets that can replace your paycheck for good, so your money works whether you do or not. That one's on screen right now.